Hey, this is Dennis Fassett, the Cashflow Mercenary. Welcome to another Monday morning episode of Cashflow Mercenary TV. Well, I told you about that Mount Clemens deal that I was looking at last week, and I submitted my letter of intent this morning. I'm excited to do this. The numbers are great, and they do warrant further study. And the cool thing about this deal is that there are a couple of factors that need to be decided that in a kind of a pre-due diligence phase that we can do for free before I commit any money, before I submit an earnest money deposit, or really before I even do a purchase agreement. So I'm going to take a week and do some digging around and see if we can't put something together on a preliminary basis and see if it makes sense to move forward. So I'm excited about that. I really wanted to take a minute here to talk to you about risk and reward and the relationship and how that relationship is screwed up here in Metro Detroit. Now, in a normally functioning market, risk and reward are tightly tied together, such that if you want higher returns on investment, you have to take on higher risks, and that's just a fact of life. You don't get something for nothing generally in a normally functioning market. But here in Metro Detroit, the markets are not functioning normally, and so that risk-reward relationship is out of whack, actually in favor of the people that want higher returns, which is a good thing. Now, what's going on is that we've got an excess of supply because there aren't enough buyers in the market and all the foreclosures. I mean, there's a bunch of things conspiring to really create an imbalance in the market in terms of supply and demand, and it's factors external to the market. So the market is not the problem. It's factors external to the market that are impacting the market, and that's creating this risk-reward imbalance. So right now, you could buy houses that are very low risk and get surprisingly high returns. Some of the houses that I'm looking at in my areas, for example, are throwing off, they've never before with cash flow as rentals, very, very low risk houses generally, are throwing off returns in excess of 20% annually. I mean, very, very good, solid returns for really limited risk. And the same is true in multifamily. You know, the multifamily, there aren't any buyers in the market, the credit markets are all screwed up. And so you're able to buy multifamily buildings, multifamily projects that normally would yield, good, healthy 10 to 15% returns on investment that now are returning over 20. And like I said, this Mount Clemens deal that I'm looking at right now is going to be in the mid-20s once it's stabilized. So again, it's all good in terms of looking at risk reward and taking advantage of it. So for somebody that's got the balls, quite honestly, to take advantage of the situation, now's the great time to buy real estate here in Metro Detroit because this risk-reward relationship is so out of balance right now. It really favors the person that's prepared and really that can make a decision. It's got the balls to make a decision and move forward instead of doing all the analysis and figuring out why it doesn't make sense to move forward, because there's always 100 reasons why not to move forward on these things. Anyway, this is Dennis Fassett, the Cashflow Mercenary. Appreciate you tuning in and look forward to talking again tomorrow.